This is a bank card, a Visa debit card issued by First Republic Bank. The card is blue and white, professionally designed, with the cardholder's name embossed in silver. It looks exactly like it did when it was issued in 2019. The magnetic stripe still works. The chip still functions. The card itself is perfectly intact. The card is also worthless. At 6 a.m. Eastern on January 30th, 2026, the Federal Deposit Insurance Corporation issued 3 simultaneous press releases. 3 separate announcements, published within a 47-second window, each containing the same 11 words with different institution names. Bank name has been closed by its primary regulator, and the FDIC has been appointed receiver. First Republic Bank, Signature Bank, Silvergate Bank. 3 banks, 3 failures. 3 announcements timed to land before markets opened, before depositors could react, before the panic that regulators knew was coming could accelerate into something uncontrollable. The combined assets of the 3 institutions, $547 billion. The combined deposits, $389 billion. The combined uninsured deposits, money above the $250,000 FDIC limit that depositors may never fully recover, $214 billion. $214 billion. Evaporated between the close of business Friday and the announcement Monday morning. Money that existed on Friday statements. Money that paid Friday bills. Money that depositors assumed was safe because it sat in regulated American banks. Gone. Not transferred. Not frozen pending investigation. Gone. Converted into claims against receivership estates that will take years to adjudicate and return cents on the dollar for uninsured amounts. And in the 4 hours since the announcements, gold has risen $287 per ounce. Silver has risen $4.73 per ounce. The largest single-session moves in both metals since the 2008 financial crisis. The correlation is not coincidental. It's causal. And understanding why 3 bank failures produce immediate, violent appreciation in precious metals reveals something about our financial system that most people don't understand until it's too late. Here's what they're not telling you. The 3 banks announced this morning didn't fail independently. They failed because of a single, shared exposure that connected their balance sheets in ways regulators either didn't see or chose not to address. Unrealized losses on Treasury securities and agency mortgage-backed securities purchased during the low-rate era of 2020-2021. First Republic held $27.4 billion in securities purchased at yields averaging 1.8%. Current yields exceed 5.1%. The mark-to-market loss on that portfolio? $8.9 billion, exceeding the bank's total equity capital. Signature Bank held $19.2 billion in similar securities, with unrealized losses of $6.1 billion. Silvergate, smaller but more concentrated, held $11.7 billion, with losses of $3.4 billion. Combined unrealized losses, $18.4 billion across 3 banks whose combined equity was $16.2 billion. The banks were technically insolvent on a mark-to-market basis, but remained operational because accounting rules permitted them to classify securities as held to maturity, avoiding the requirement to recognize losses until securities were sold. The classification worked until it didn't. Until depositors began withdrawing funds at a pace that forced the banks to sell securities. Until the sales crystallized losses that accounting had obscured. Until the crystallized losses consumed equity and left the institutions unable to meet withdrawal demands. The trigger wasn't a single dramatic event. It was cumulative withdrawal pressure that accelerated throughout January. First Republic saw $31 billion in deposit outflows between January 2nd and January 24th, roughly $1.4 billion per day leaving the bank. Signature saw $18 billion. Silvergate saw $7 billion. The outflows weren't random, they were informed. The sophisticated depositors who monitor bank balance sheets, hedge funds, corporate treasuries, wealthy individuals with accounts exceeding FDIC limits, recognized the securities losses that accounting rules concealed. They withdrew while withdrawal was still possible. The withdrawals forced security sales. The sales crystallized losses. The losses consumed capital. The capital shortfall triggered regulatory closure. The cascade from depositor awareness to bank failure took 28 days. Less than a month from "this bank has a problem" to "this bank no longer exists." This is where the lie becomes unsustainable. The 3 banks announced this morning are not unique. The unrealized securities losses they carried exist across the American banking system. The FDIC's own data, published quarterly, available to anyone who reads regulatory reports, shows $682 billion in unrealized losses across all FDIC-insured institutions as of Q4 2025. $682 billion. Losses that exist but haven't been recognized. Losses carried by banks that remain operational because accounting rules don't require recognition until securities are sold. The losses aren't evenly distributed. They concentrate in banks that grew aggressively during the low-rate period. Banks that took in deposits and invested them in seemingly safe treasury and agency securities at yields that seemed acceptable in 2021, but proved catastrophic when rates rose. The pattern that killed First Republic, Signature, and Silvergate exists at dozens of other institutions. The names are visible in regulatory filings. The losses are calculable from publicly available data. The vulnerability is not secret. It's simply unacknowledged by a financial media that treats bank stability as default rather than exception. The paper versus physical distinction that has defined precious metals analysis for months now applies to the banking system itself. Bank deposits are paper, claims on institutions that may or may not be able to honor them. The $389 billion in deposits at the three failed banks existed as ledger entries, as numbers on statements, as confidence that institutions would perform when asked. The deposits weren't money in any physical sense. They were promises. Promises from banks to depositors that withdrawal requests would be honored. Promises that proved only as reliable as the bank's ability to liquidate assets at values sufficient to meet them. When the assets couldn't be liquidated at those values, when the securities losses consumed the capital that backed depositor promises, the promises failed. The paper became worthless. Physical assets don't carry this counterparty risk. Gold in a vault doesn't depend on any institution's solvency. Silver in allocated storage doesn't become worthless when a bank fails. Bitcoin in self-custody doesn't require anyone's permission to access. The $287 gold surge and $4.73 silver spike this morning represent capital fleeing counterparty risk. Money that was deposited in banks recognizing that deposits are promises and promises can fail. The capital is converting from claims to possession, from paper to physical, from trust in institutions to trust in assets that don't require trust. When institutions do what they're doing now, they're not managing a contained crisis. They're fighting contagion they may not be able to stop. At 7:15 a.m. Eastern, 75 minutes after the FDIC announcements, the Federal Reserve issued an emergency statement activating the Bank Term Funding Program at enhanced capacity. The BTFP allows banks to borrow against Treasury and agency securities at par value rather than market value. The facility was created during the March 2023 banking stress specifically to address the problem that killed this morning's three banks: unrealized securities losses that become realized when depositors withdraw. The enhanced capacity language signals that borrowing against the facility will increase dramatically. Banks that face withdrawal pressure can now access liquidity without selling securities at losses. The facility provides a bridge, but the bridge doesn't eliminate the losses. It merely delays their recognition. At 7:47 a.m. Eastern, the Treasury Department announced that the FDIC's Deposit Insurance Fund would be backstopped by a $180 billion credit facility from the Treasury. The announcement came with language that has never appeared in previous banking crises. All depositors at the three institutions will be made whole, regardless of insurance limits. All depositors made whole, including the $214 billion in uninsured deposits that, under normal FDIC procedures, would recover only partial value through receivership proceedings. The Treasury is using taxpayer backstops to protect depositors who chose to hold amounts exceeding FDIC insurance at institutions with visible balance sheet stress. The policy choice has profound implications. It establishes precedent that uninsured deposits are effectively insured, that the government will protect large depositors at failed banks, even when those depositors took risks by exceeding insurance limits. The precedent creates moral hazard. Why monitor bank health if the government protects you regardless? Why keep deposits within insurance limits if limits don't matter? Why choose strong banks over weak banks if all deposits receive equal protection? The precedent also signals desperation. Policymakers wouldn't establish such dangerous precedent unless they feared the alternative more. The alternative, letting uninsured depositors take losses, would trigger runs at every bank with similar securities losses. The runs would crystallize losses, consume capital, and create more failures. The backstop is an admission. The banking system cannot withstand the losses it carries if those losses are forced into recognition. The only solution is to prevent recognition, to provide liquidity that averts the sales that would crystallize losses, to protect depositors whose flight would force those sales. The Fed and Treasury are not solving the problem. they're postponing it. The $682 billion in unrealized losses still exists. The securities are still underwater. The banks are still technically insolvent on a mark-to-market basis. The accounting rules that conceal this insolvency remain in effect. What's changed is that sophisticated depositors now know, with the morning's announcements, that the concealment can fail. That 3 banks carrying securities losses are now in receivership. That the pattern can replicate wherever the same losses exist. The knowledge changes behavior. The behavior changes outcomes. The outcomes determine whether this morning's failures are isolated events or the beginning of something much larger. Less than 48 hours remain before markets fully digest the implications. The announcements landed pre-market Monday. The stock market opens in minutes. The bond market is pricing bank risk in real time. The precious metals markets have already delivered their verdict. $287 on gold, $4.73 on silver, and the verdict may prove conservative. The countdown is to recognition, the moment when market participants fully internalize that the $682 billion in unrealized losses can become realized losses at any bank, at any time, whenever depositor behavior forces securities sales. That recognition produces flight from bank deposits toward assets that don't carry counterparty risk. The flight has already begun. Since 6 a.m., Google searches for bank run have increased 4,700%. Searches for FDIC insurance limit have increased 8,200%. Searches for how to buy gold have increased 3,400%. The search data shows population scale awareness emerging in real time. The questions people ask reveal the fears they're processing. The fears produce behavior. The behavior determines whether the morning's failures remain isolated or cascade. While American banks fail, Eastern institutions observe and position. At 8 a.m. Beijing time on January 30th, 7 p.m. Eastern the previous evening, before the failures were announced, the People's Bank of China published updated guidance for domestic financial institutions regarding international counterparty risk management. The timing is suspicious. China's guidance, advising domestic banks to reduce exposure to institutions in jurisdictions experiencing financial sector stress, was published hours before the stress became public. Either China's financial intelligence identified the coming failures before American depositors did, or the timing is coincidental. The guidance itself is not ambiguous. Chinese banks should limit exposure to American financial institutions. The limit applies to correspondent banking relationships, derivative counterparties, and deposit placements that Chinese institutions maintain with U.S. banks. The guidance effectively quarantines Chinese banks from whatever contagion the American failures produce. The quarantine suggests Beijing expects contagion, expects that this morning's 3 failures are not the end but the beginning. Russia's response arrived within hours of the FDIC announcements. The Russian central bank issued a statement, brief, pointed, designed for international consumption. Recent developments in American banking demonstrate the risks inherent in dollar-denominated financial infrastructure. Russia's diversification toward gold-backed settlement mechanisms provides insulation from instabilities originating in Western financial systems. The statement is propaganda, but propaganda built on truth. Russia's gold reserves, 2,350 tons, the 5th largest in the world, provide backing for settlement mechanisms that don't depend on dollar-denominated banks. The American bank failures validate Russia's strategy of building alternatives. The BRICS payment system, scheduled for pilot testing in Q2 2026, suddenly has operational urgency it lacked last week. The system was designed to reduce dependency on dollar infrastructure. This morning's failures demonstrate why reducing that dependency matters, why nations that rely exclusively on dollar-based banks face risks that nations with alternatives do not. The geographic bifurcation that has characterized financial markets for years accelerates this morning. The failures are American. The contagion is dollar-based. The alternatives, gold, the BRICS system, non-dollar settlement, gain relative credibility with each American bank that fails. The gold and silver spikes reflect this bifurcation in real time. Precious metals are not American. They're not dollar-denominated in any fundamental sense. They exist outside the banking system that failed this morning. Their value doesn't depend on any institution's solvency. The money flowing into metals this morning is money flowing out of the system that produced the failures. The correlation between bank collapse and metal appreciation is the correlation between institutional failure and asset independence. This is what a system looks like when it runs out of time. The $682 billion in unrealized losses accumulated over years, the low-rate policies of 2020-2021 encouraged banks to reach for yield. The yield they reached for came with duration risk they didn't fully appreciate. The duration risk manifested as losses when rates rose. The losses remained unrecognized because accounting rules permitted concealment. The concealment worked while confidence held. While depositors believed their banks were solvent, they left deposits in place. The deposits funded operations. The operations continued. When confidence broke, when depositors recognized that accounting concealment didn't equal actual solvency, the withdrawals began. The withdrawals forced sales. The sales crystallized losses. The losses consumed capital. The banks failed. The trap has no exit that preserves the current system. The Fed can provide liquidity through the BTFP, but liquidity doesn't restore solvency. A bank with $8.9 billion in unrealized losses and $5.2 billion in equity is insolvent regardless of how much liquidity it can access. The liquidity postpones the reckoning. It doesn't prevent it. The Treasury can backstop the FDIC, but backstops don't restore confidence. Depositors who see 3 banks fail in one morning don't trust assurances that their bank is different. They check balance sheets. They calculate securities losses. They withdraw deposits from any institution that shows the pattern, and dozens of institutions show the pattern. The withdrawals continue. The pressure mounts. The next failures approach. The question is not whether additional failures occur. The question is timing and magnitude. The $682 billion in unrealized losses doesn't disappear because 3 banks failed. It redistributes, concentrating in the institutions that haven't yet faced withdrawal pressure, waiting for the moment when their depositors recognize the vulnerability. This morning's announcements provide the template. First Republic, Signature, Silvergate failed because their securities losses were recognized. The remaining banks carry the same securities losses. The remaining depositors now know to look for them. The gold and silver prices incorporate this knowledge. The $287 surge and $4.73 spike aren't reactions to 3 banks failing. They're reactions to the recognition that 3 failures signal dozens more potential failures. They're pricing the systemic risk that this morning's announcements reveal. Physical metals are the destination for capital that no longer trusts bank deposits. Gold in a vault doesn't carry unrealized securities losses. Silver in allocated storage doesn't depend on accounting rules that conceal insolvency. The metals exist independent of the banking system, and independence from the banking system is precisely what this morning's events reveal as valuable. Those who held bank deposits above FDIC limits at the 3 failed institutions are learning this lesson expensively. The $214 billion in uninsured deposits may be backstopped. The Treasury's announcement suggests they will be. But the backstop comes with delays, with uncertainty, with the recognition that their money was not as safe as they assumed. Those who held physical gold or silver this morning learned a different lesson. Their holdings appreciated. Their wealth increased in nominal terms, even as the banking system demonstrated fragility. Their decision to hold assets outside the system proved correct precisely when the system failed. The contrast is the lesson. Paper claims versus physical possession. Institutional dependency versus asset independence. Trust in banks versus trust in metals. The lesson is being learned at population scale this morning. The Google searches show the learning happening. The metal prices show the learning translating into action. The bank stocks, down 12 to 18% across the regional bank index in pre-market trading, show the market's assessment of who faces similar risks. Reality asserts itself through failures that cannot be explained away. 3 banks, $547 billion in assets, $389 billion in deposits, closed between Friday evening and Monday morning. The narrative that the banking system is sound confronts the reality of 3 simultaneous failures. The narrative that 2023 was contained confronts the reality of identical patterns producing identical outcomes 3 years later. The narrative that regulators are vigilant confronts the reality of accumulated losses that regulators permitted to grow until they became catastrophic. The narratives lose credibility. The metal prices gain. The correlation is direct. Confidence in institutions declining as confidence in physical assets increases. The $287 gold move and $4.73 silver move are not endpoints. They're the market's initial response to information that arrived before breakfast. The full digestion of that information takes days. The behavioral changes it produces take weeks. The capital reallocation it triggers takes months. The moves this morning are the beginning. The metals explode because 3 banks collapsed. The explosions continue as the market recognizes that 3 banks are not the end. The bank card on my desk, the blue and white First Republic Visa, is plastic. It will sit in a drawer, a memento of an institution that no longer exists, a reminder that cards can function perfectly while the institutions behind them fail completely. The gold coin beside it, a 1-ounce American Eagle purchased in 2019, the same year the card was issued, is worth $287 more than it was yesterday. The coin doesn't depend on First Republic or Signature or Silvergate. The coin doesn't depend on any bank. The coin exists independent of the system that failed this morning. The contrast is everything. Paper versus physical. Claims versus possession. Trust versus independence. The bank card is worthless. The gold coin is worth $287 more than yesterday. 3 banks collapsed. Metals exploded. The correlation will continue until the causes resolve, until the $682 billion in unrealized losses is recognized, absorbed, and eliminated from the banking system. That process takes years. The metal appreciation that accompanies it takes years too. This morning was the beginning. The failures announced. The metals responded. The lesson delivered. The question is whether the lesson is learned before the next 3 banks fail, or whether it takes more failures to teach what this morning should have made obvious. Paper fails. Physical doesn't. 3 banks proved it this morning. The metals priced it instantly. Everything else is commentary.